Right now, as you're watching this, gold is sitting above $4,130 an ounce, up more than 1% today. Silver just pushed past $60, up over 2% in a single session. If you own either one, today already felt good, but I need you to hear this before tomorrow, because tomorrow brings the first of two data releases this week that could decide whether this rally keeps going or reverses hard. And Snort's the second one, arriving Friday morning, is the one almost nobody watching today's green numbers is fully prepared for. Ladies and gentlemen, if you own gold or silver, or if you've worked and saved your whole life and you're simply trying to protect what you have, give me the next few minutes. Tomorrow, Thursday, the government releases weekly jobless claims data. It sounds routine, it isn't, not this week. And on Friday morning, the single most important economic report of the month lands, the one that will tell the Federal Reserve and every trader on earth whether the U.S. labor market is actually as weak as recent numbers suggest. By the end of this video, you'll understand exactly why this sequence matters for your metals, what to actually watch for, and why the smartest money isn't reacting to today's green numbers the same way the crowd is. Stay with me, because what happens over the next 48 hours could shape where gold and silver go for the rest of the month. Section 1, why this week is different. Let's start with why this particular week carries more weight than a normal data week, because Snort's the setup here has been building for months. At the end of July, the Federal Reserve held interest rates steady, but it wasn't a clean, boring hold. The vote was 9-3, with three regional Fed presidents pushing to raise rates rather than hold them, worried that inflation from the ongoing Middle East conflict and elevated oil prices hasn't been tamed. That's a genuinely split committee, not a unanimous one. And a split Fed means the market has to work harder to guess what comes next. At the same time, the labor Snorts market has been sending mixed and increasingly worrying signals. June's jobs report showed only 57,000 jobs added, well below what the economy needs just to keep up with population growth. And the Snort's two prior months were revised down by a combined 74,000 jobs. That's the kind of number that normally would push the Fed toward cutting rates to support the economy, but it's colliding directly with the inflation risk from the Iran conflict and elevated energy prices, which pushes the Fed the opposite direction. That collision, a softening labor market against a hawkish inflation risk, is exactly why the vote was split. And it's exactly why this week's data carries so much weight. Layer on top of that what's happening outside the U.S. entirely. The Bank of Japan just held its own rate steady, while the yen sank to its weakest level against the dollar in roughly 40 years. And Japan has had to intervene in currency markets multiple times this year to slow the slide. Second quarter U.S. GDP came in below forecasts, and the ceasefire between the U.S. and Iran has been fragile at best, with oil prices swinging on any hint that the pause might not hold. Every one of these threads feeds into the same question the Fed is wrestling with. Is the economy weak enough to justify cutting rates, or is inflation risk too high to risk it? That's the tension sitting underneath tomorrow and Friday. Quick ask before we go further. If you're holding gold or silver right now and trying to figure out how to think about this week without panicking either direction, hit subscribe, because we'll be back the moment Friday's number lands to break down exactly what it means. And I want to know, are you holding through this week's data, or are you watching from the sidelines waiting for more clarity? Tell me in the comments. I read everyone. Now, let's get into the mechanics, because you need to understand why a jobs number moves the price of a metal that has nothing to do with employment. Section 2, why jobs data moves your metals at all. Here's the simplest way to understand it. Gold and silver pay you nothing. You hold them, and they just sit there. No interest, no dividend. A government bond, on the other hand, pays you a yield, and that yield is directly shaped by what the Federal Reserve does with interest rates. When the labor market looks weak, that increases the odds the Fed cuts rates to support the economy. Lower rates mean bonds and savings accounts pay you less, which makes a zero-yield asset like gold or silver relatively more attractive by comparison. That's part of why gold and silver are up today. Weak recent labor data has raised the odds of a September rate cut. But when a jobs report comes in stronger than expected, it can flip that calculus instantly. A hot jobs number makes the Fed less likely to cut. Sometimes even reopens talk of holding rates higher for longer, and that pulls money out of metals and into yield-bearing assets. So tomorrow's job claims report matters because it's the last real data point before Friday, a preview that traders will use to adjust their expectations heading into the big release. It won't move markets nearly as much as Friday will on its own, but a surprise in either direction tomorrow can shift the mood heading into the weekend's most important number. Friday's non-farm payrolls report is expected to show somewhere between 100,000 and 130,000 new jobs, with unemployment sitting around 4.2 to 4.3%. If it comes in meaningfully below that range, especially if it echoes June's weak 57,000 print, expect the market to lean harder into rate cut bets, and gold and silver could extend today's rally. If it comes in meaningfully above that range, showing the labor market is actually holding up fine, expect the opposite. Rate cut odds fade, and your metals could give back today's gains quickly. Section 3, the two-day sequence you need to watch. Let me walk you through the actual sequence, because most people watching today's rally are only thinking one move ahead. Tomorrow, Thursday at 8:30 in the morning, the weekly jobless claims number comes out. On its own, this is a smaller, noisier data point. It moves around week to week and doesn't carry the weight of a full jobs report. But this week, it's not standing alone. It's the market's last chance to recalibrate before Friday. And if claims come in notably higher than expected, suggesting more layoffs in a cooling labor market, it could reinforce the case for a September rate cut and add fuel to today's rally in gold and silver. If claims come in lower than expected, suggesting the labor market is more resilient than feared, it could cool that enthusiasm heading into Friday. Then Friday morning, the non-farm payrolls report lands. And this is the one that actually moves the needle. This is the report the Fed itself weighs most heavily when thinking about its September decision. Think about the sequence. A smaller data point Thursday morning that sets the mood than the single most important labor market report of the month Friday morning that can confirm or completely overturn whatever that mood suggested. Most casual observers will only notice Friday's headline. The people who actually understand this market are also watching Thursday because it tells you which direction the surprise is more likely to break. There's a further layer here worth knowing about. Because June's report was so weak, and because 2 prior months were revised down so sharply, there's real uncertainty about how reliable these numbers even are right now. And Fed officials have said as much. That uncertainty is part of why the committee itself was split 9-3. A single data point landing hot or cold in this environment carries outsized power to move expectations precisely because the market doesn't have a stable, confident read on where the labor market actually stands. Section 4, the honest near-term risk. I promised you honesty, and honesty means telling you plainly that the near-term risk here runs in both directions, not just up. Gold and silver are both still well below their all-time highs from late January, when gold briefly touched above $5,500 or $100 an ounce, and silver spiked past $121. Since then, both sorts of metals have been through a genuinely volatile year, including silver's steepest single-day plunge since the 1998 seconds at the end of January and a slower grind back. This left both metals trading well under those peaks, even after today's rally. Some analysts, including strategists at Macquarie, expect gold to stay range-bound for the rest of the year before gradually drifting lower into 2027 if inflation and bond yields keep climbing. Precisely the scenario a strong jobs report tomorrow and Friday could trigger. If Friday's number comes in hot, don't be surprised if gold and silver give back a meaningful chunk of today's gains, potentially within hours of the release. Anyone telling you these metals only go up from here isn't being straight with you. This is a genuine two-sided moment, and the setup, a Fed that's internally split, a labor market whose own data the Fed doesn't fully trust, and a fragile geopolitical backdrop means volatility in both directions is the realistic expectation, not a smooth continuation of today's move. Section 5, what's sitting underneath all of this? But here's the other side, and it's why the most sophisticated buyers in this market aren't reacting to a single week of data the way retail investors tend to. In the second quarter of this year, gold ETFs, the funds that ordinary investors use to get exposure to gold, actually shed about 45 tons as retail sentiment cooled. Central banks, meanwhile, added roughly 289 tons in that same quarter, more than 6 times as much, according to World Gold Council data. That's not a coincidence. Central banks aren't trading around a Thursday claims number or a Friday payrolls report. They're positioning around a multi-year view, elevated government debt levels in the U.S. and elsewhere, a fragile geopolitical backdrop with Japan's currency under real stress, and the Middle East ceasefire still shaky, and a structural silver deficit that the Silver Institute expects to run again this year, somewhere in the neighborhood of 67 million ounces short of what the market needs. None of that changes because of one jobs report, whichever direction it breaks. That's the pattern worth understanding. The short term is genuinely a coin flip this week, shaped by data neither the Fed nor the market fully trusts right now. The longer term positioning from the world's central banks tells a different, steadier story, one that isn't waiting on Thursday or Friday to make up its mind. Here's your plan for the next 48 hours, so you're prepared instead of reacting. Tomorrow morning, watch the jobless claims number, not because it will move your metals dramatically on its own, but because it tells you which way the mood is leaning heading into Friday. Then Friday morning, watch the actual jobs report. If it comes in weak, especially anywhere near June's soft 57,000 print, expect gold and silver to have room to extend today's move. If it comes in strong at or above that 100,000 to 130,000 range, with unemployment holding near 4.2 to 2%, expect the metals to face real pressure, possibly giving back today's gains quickly. Whatever happens Thursday or Friday, remember what's sitting underneath it. A Fed that's internally divided, a labor market whose own numbers the Fed doesn't fully trust yet, a structural silver deficit that isn't solved by any single week's data, and central banks that added 6 times more gold than retail investors sold in the second quarter alone. Positioning for years, not for Friday morning. The short term this week is genuinely uncertain in both directions. The longer term case hasn't changed because of it. I want to hear from you. Are you watching Thursday's claims number, or are you only paying attention Friday when the real report lands? And how are you positioning going into it? Tell me honestly in the comments. I read every single one, and it helps me understand what to dig into for the next video. If this snorts helped you walk into these next 48 hours with a clearer head, instead of reacting to whatever headline hits your phone, subscribe before you go, because the moment Friday's number lands, I'll be right back here to break down exactly what it means for your gold and your silver.